Hi friends, I am Mervin Fernandez, a chartered accountant by profession, qualified from the Institute of Chartered Accountants of India. In this short video, we are going to discuss about the first step in the process of accounting, which is journal entry. I have done a short video on how a journal entry is framed based on the traditional approach of classification of accounts, where I have explained what are the classification of accounts, what are the rules applicable to each account, and how a journal entry is being framed based on the same. The link of the same is given in the description box below. Here we are going to look into how a journal entry is being passed based on the modern approach of classification of accounts. Modern approach of classification of accounts is based on the accounting equation which states assets is equal to capital plus liabilities. That means every asset that is owned by the entity or a concern is either sourced by outsiders funds, which is liabilities, or owners funds, which is called the capital. Keep in mind, every transaction that occurs in an entity or a concern is recorded into the books of accounts through a journal entry having a debit aspect and a credit aspect. And the debit amount will be obviously equal to the credit amount. Every asset owned by an entity will have a debit balance. That means the nature of an asset account will be always that of debit. So we have seen that assets is equal to capital plus liabilities. So since asset is having a debit balance or debit nature, obviously capital and liabilities will have to be credit balance. So assets have a debit nature, capital and liabilities will have a credit nature. So now let's add two more accounts here, revenue and expenses. Every revenue that is earned by an entity is ultimately going to be added back to the owner's funds. So the nature of a revenue account is same as that of the owner's funds, which is the capital. So revenue will always have a credit nature. Now take the case of expenses. Expenses is going to be ultimately deducted from the owner's funds. So the nature of expense is the opposite of the owner's capital. So expense will have always a debit nature. So now based on this accounting equation, we have seen 5 classification of accounts, which is assets, capital, liabilities, expenses and revenue. These are the 5 classification of accounts under the modern approach of classification. Now let's see how a journal entry is being framed based on the modern approach of classification of accounts. Unlike traditional approach, there are no much rules applicable to each type of account. Here what we do is that we identify what is the movement that happens in each type of account, whether there is an increase or a decrease in the account. Here the simple rule is, if the nature of the account is debit, then every increase in that account has to be debited and every decrease has to be credited. And if the nature of the account is that of credit, every increase in that account has to be credited and every decrease has to be debited. So this rule we need to apply to these 5 types of accounts. Assets and expenses are having a debit nature. So every increase in an asset or an expense has to be debited and every decrease in an asset or an expense has to be credited. Similarly, revenue, capital and liabilities are having a credit nature. So every increase in these 3 accounts will have to be credited and every decrease in these 3 accounts has to be debited. This is a simple rule that applies to frame a journal entry based on the modern classification of accounts. Whenever a transaction occurs, there are 3 steps that needs to be taken care. 1. Understand the accounts that are involved in the transaction. 2. Identify the type of the account. 3. Understand the movement in that particular account and apply the respective rule. Now let's see a few examples as to understand how an entry is being passed based on the modern classification of accounts. January 1, Tom introduced capital in cash 50,000. The first step in framing a journal entry is identify the accounts that are involved in the transaction. Here there are two accounts that are involved. One is Tom and second is cash. Second step, identify the type of account. Now Tom is the owner of the business and his contribution is capital, and cash is an asset of the company. Now the third step, you understand what is the movement in each type of account. Here capital is increasing because capital is being introduced into the business. Since capital has a credit nature, every increase has to be credited, so capital account has to be credited here. Cash is an asset which has a debit nature, so every increase of cash is to be debited here. So the entry is cash account debtor to capital account. Cash is debited, capital is credited. So now come to the journal book. Now date column January 1. In the particulars column we have to mention the accounts that are debited and credited along with the narration of the transaction. Debit amount column, the amount that has to be debited to the respective account, and in the credit amount column, the amount that has to be credited to the respective account. So in the particulars column here, we have to mention cash account debit to Tom's capital account. Debit amount column, 50,000 for the cash that is being debited, and in the credit amount column, 50,000 for the capital that is being introduced into the business. Now another example, January 3rd, sold goods to Jerry for 15,000. First step, we need to identify the accounts that are involved. The two accounts involved are sales and Jerry. Second step, we need to identify the type of account. Sales is a revenue account and Jerry is an asset in this case because the money is receivable from Jerry. So now we need to identify what is the movement in these two types of accounts. Here sales is increasing and there is an increase in the asset as well. So every increase in a revenue account has to be credited and every increase in asset account has to be debited. Your entry is Jerry account debit 15,000 to sales account 15,000. Now come to the journal. Date column January 3rd. Particulars column, the accounts that are debited and credited along with the narration. Jerry account debit to sales being goods sold on credit to Jerry for 15,000. In the debit amount column, mention the amount that has to be received from Jerry, and in the credit amount column, mention the amount of revenue that has been erased, which are both 15,000 each. Yet another example, January 4, paid salaries from bank 10,000. First step, identify the accounts. Salary is one account, bank is another account. Second, identify the type of account. Salary is an expense account and bank is an asset account. Third step, identify the movement that occurs in each account. Here there is an increase in the salaries that we have incurred and there is a decrease in the bank account. So expense being a debit nature account, the increase has to be debited, and asset being a debit account, a decrease in the asset has to be credited. So your entry will be salaries account debtor to bank. Coming to the journal, date column January 4, particulars column, salaries account debit to bank account being salaries paid from bank. Debit amount column, you mention the amount of salaries that has been incurred, which is 10,000, and credit amount column, we mention the amount that has been paid out from the bank, which is 10,000. This is how a journal entry is being framed based on modern classification of accounts, where the debit and credit is finalized based on the movement that occurs in each type of account. Now, whenever an entry is being passed, you can use either the modern classification of accounts or you can base it on the traditional classification of accounts, but the journal entry that comes into place will be the same. Hope you have understood how accounts are classified based on the modern approach of classification, and how entries are being passed based on this classification. Thanks for watching. Bye bye.